Scale is the blockchain that's truly built different. Explore more at scale.space/ecosystem and follow them on X at Scale Network. Crypto's premier institutional conference is returning to New York on March 18th to 20th. We're hosting one of the world's best crypto conferences for institutional and professionals alike. It's going to be a ton of fun. I'm going to be there hosting a variety of different panels. I'll be doing a fireside chat with Mohamed El-Arian, a different macro panel with Jim Bianco and Joseph Wang. And we're also going to be doing a live forward guidance roundup there where myself, Tyler, and Quinn will be chopping it up live for the guys Emporium. So make sure to get your tickets. It's going to sell out quick. I know it. It's going to be a ton of fun. So come on out and yeah, just hit the link in the show notes and you can go purchase your ticket today. All right, welcome back to another episode of Forward Guidance. And joining me today is Dr. Benn Eifert, managing partner at QVR Associates. Ben, you are the volatility guy. You were very much around on Twitter and FinTwit for a long time during the time of XIV 2018, Volmageddon, when, it was the hot thing to do was the short vol. And, that's when I first heard about you and started to follow your work. And then you dropped off the face of the earth for a little bit, and now you're back and you're doing the rounds. I listened to your just on the All Lots pod, which was really great. Listen to that, and yeah, also honored to have you on Forward Guidance again. How you doing?
Awesome, man. It's really great to be back. Thank you. Nice to see you.
Yeah, likewise. Okay, so I want to start off from the top line for those that may not be aware of what you do and what do vol-focused hedge funds do as a principle. So I'd love to just open it up to you to talk a little bit about like what does it mean to put forth volatility-focused strategies, and what are some of the different tools in the tool shed that you utilize to actually put on these trades and how to focus on them.
Sure, absolutely. So I'll speak for us. Obviously, there's lots of different kinds of vol and derivatives funds, but at least in terms of how we think about the world, ultimately, derivatives markets are sort of these secondary markets, right? Not sort of equity markets, or they're not really about asset allocation. They're about the dominant forces are the end users of derivatives, who are not our volatility arbitrageurs with PhDs in math. They're just sort of pension funds that have some hedging to do, or retail investors who are buying structured notes for income and investment purposes. And those flows are what moves prices around in derivatives markets. They're what set the relative prices of related derivatives. And ultimately, that can create dislocations in markets and relative pricing inefficiencies that need somebody on the other side to study them, to understand them, and to take the other side of those flows and to buy the things that are cheap and to sell, to hedge with the things that are expensive. And so that's, ultimately what we do. That's the source of all, if you think of alpha in the derivative space, that's where it comes from, is just, dislocations in derivatives markets driven by buying and selling by relatively price insensitive, people. And then the name of the game is all about, how do you structure trades around those dislocations? How do you manage the risk? How do you make sure that you don't blow up or take, negatively convex risk that gets you in trouble? All that sorts of stuff.
To execute on those different types of trades, there's a lot of different vehicles that could be utilized for different reasons. So I'd love to just allow you to educate and just kind of get people up to speed on some of those different tools. There's different, obviously, you can decide on how to isolate the types of risks that you want to expose yourself to, and what are you trying to focus on in terms of capturing that alpha. So we'd love to just hear, for example, like just starting from the top line, like what does it mean to be focused on like cross asset, volatility arbitrage, for example? And, what are some of these different tools that, you can utilize, such as, there's the talk of like variance swaps and volatility swaps, which is, pretty esoteric when, I would say like the, baseline education around swaps as a principle are like interest rate swaps and that sort of thing. So we'd love to just hear, some of those specifics on what are these tools and how do you utilize them in specific risk scenarios?
Yeah, absolutely. So I would first make a one big categorization or distinction from a product perspective into listed products, things like options, and then on the other hand, OTC products, so things like variance swaps that you mentioned. So when you think about volatility, options and vanilla options are really the benchmark building block of all derivatives in a sense, or all volatility exposures. Options have been around for an extremely long time, right? A call option gives you the right to buy a stock at a predetermined price on a predetermined date, and that creates a volatility exposure because the value of that option if there's a lot more uncertainty around price in the future, the value of that option is much higher, because when I buy that option, I might buy it for $2 and I'm only risking $2, right? So the worst thing that can happen is, the stock doesn't go up enough or the currency doesn't go up enough and I don't get any payoff from it and I spend my $2. But if that underlying goes up a ton, I get to buy it for really cheap. I only paid $2 for that and I make a ton of money, right? So all else equal, I love it if the world is more volatile, more uncertain, right? And that idea is the building block of all kind of volatility trading and volatility exposure, right? That is, options create volatility exposure. You can trade options in different ways to synthesize different kinds of volatility exposures and take views in different ways on volatility. A lot of people trade options, but don't think about volatility and the pricing of volatility, and that's a big pitfall, because actually that really drives the value and performance of any kind of option strategy. And then there are many more esoteric derivatives instruments that you can trade over the counter with a bank, like a volatility swap or a variance swap, where the bank will offer you that product and then they'll go and hedge that product using options, right? So options are kind of the building block. And some of those things are relatively straightforward, like you mentioned, the variance swap. But that's something that actually has a kind of a replication where you can trade a certain set of options and more or less replicate a variance swap, and that's really cool. A lot of them are much more complicated, where the bank trying to hedge that product, has to do like dynamic options trading in a complicated way to kind of try to hedge. The volatility and variance swaps are something that come up a lot in volatility trading, just because they are actually very simple and pure expressions of volatility. And so one nice thing about a volatility swap, let's say I buy a 3-month volatility swap on the S&P 500 at 15 vol, we just measure realized volatility over that 3 months, and if it's 16, then I make 1 point, because I bought it at 15 and we realized 16, and that's really easy to understand and really simple. No kinds of strange path dependence. It's not like trading a bunch of options and having to delta hedge them and trying to extract volatility from the market. So that's very cool. Variance swaps are very similar, except that they're exposed to the square of volatility, which is variance. And so you get the same kind of exposure, except for you pay off a lot if you buy volatility and it goes up a lot, because you're actually exposed again to a payoff that's volatility squared. And then you pay a premium for that if you want to buy a variance swap over what you would pay for a volatility swap. The flip side of that, of course, is if you're short the variance swap, it's very dangerous, because you can lose a massive amount of money. And we can obviously I talk about that a lot. So there's many different tools in the world of volatility, but you can think about all of them in simpler ways, and how they would be reflected in listed options. At QVR, actually, we trade exclusively listed. So in the old days, I used to trade mostly OTC derivatives. That was sensible in a sort of pre-Dodd-Frank, pre-Basel III world, where banks really liked trading aggressively with hedge funds in big size, making big markets with tight spreads. That all really changed with major regulatory overhauls, and banks are just much less interested in that kind of thing now. A lot of the volume in derivatives markets have moved onto exchange in listed equity options, where now there are massive volumes with retail participation and big institutional investor participation. And so we've migrated entirely to those markets, where we can trade very efficiently, sort of like market makers in listed options markets, representing our interested mid-market and executing big size without having to deal with OTC confirms and counterparty risk and novations and all the things that come up with that.
Mm-hmm. Interesting. Okay, so I want to take that lens and elevate it to just getting a good understanding of what's the big goal here of what you do specifically, and what these vol focused funds do. Is it to basically just capture alpha that has nothing related to beta, like market beta? So like just to put that super simply, it's like you don't really care where the S&P goes on any given day. You're super focused on isolated risk reward profiles, and to that end, there's very not simple, like I wouldn't call a variance swap or volatility swap simple, but in terms of like the risk that you take on, it's quite simple. Versus, to your point, like if you tried to express that same view in options, you're dealing with a lot of different Greeks at the same time, and this is what I believe gets into the to the sketchy territory that you're often a critic of, which is that, people buy a call option because they want to just, get a view of delta and just see price go up. And in reality, there's a lot more going on underneath the surface. So we'd love to just hear, yeah, like what is the big idea? Is it to just capture alpha without having to have any beta exposure and just, provide that to your LPs, et cetera?
Yeah, exactly. So we do a few different things. Absolute return is exactly what you described. Our job in absolute return is to make money over time in a way that has nothing to do with beta and has nothing to do with markets. In practice, what that tends to look like, in our case, is we hope to be able to do, kind of fine, reasonably well in normal market environments, but certainly not keep up with, massive 20% equity returns or something like that. But then we tend to do very well when markets are crashing and blowing up, but not because we're long volatility, but just because the world gives you lots of opportunities. As long as you're in a position of strength, there's free money everywhere in those environments because everybody's blowing up and being forced to liquidate risk. And there's just lots of interesting things to do. So that's a return profile that's really interesting to asset owners because ultimately that's the sort of the complement of what their portfolio looks like, right? They make a lot of money when things are good, and then they lose a lot of money all of a sudden when things are really bad, right? So that's really what we do. And then, we also, in really large investors come to us and ask for help creating kind of customized tail risk hedges or things like that, since we have a lot of derivatives expertise. And so, with a few big, really good friends and partners, we'll do things like that too.
And so, yeah, it feels like one of the big trends these days is these vehicles these ETF vehicles specifically are taking these, what were traditionally esoteric or more exotic derivative vehicles, such as, swaps and different options profiles, things like collars, risk reversals, et cetera. And it seems like they're bringing them forth into an ETF package and then packaging them up nicely and saying, here is the specific risk return profile that we can give to you, and, take it and, go on your day and enjoy the specific outcome that we're promising you or whatever. So I would just love to, open it up to you to just explain, why has this trend occurred where we've seen this ETFification of derivative products tied to like some sort of, I don't know, equity, index or something like that. And what are some of the undue risks, or at least, like undue risks that people may not be aware of as they start to look at these new ETFs that are coming onto the market?
Yeah, no, it's a great question. I mean, there's a few different categories of these ETFs. So I would describe some of them as like access products, right? Where what you're effectively getting is access to a risk factor that would otherwise be difficult to trade if you're just an individual investor. So like the best example of that historically was VXX and like the volatility ETFs, right? Where a retail investor might not know what a VIX future is or how to get a futures account and trade those things and how to roll them over time and all this, but you can just go and buy an ETF that does that for you, right? So that's a very popular type of ETF, again, that people have gotten into because they want a volatility exposure. They like this idea that they can either bet that the world is going to blow up and vol's going to go up, or they can see a volatility spike and they can short it because they think volatility is going to go back down. That's one category. I would say the other category is more like strategy products, where they're buying some kind of option strategy that similarly would be difficult for them to implement themselves. They have to go out and trade options, maybe multiple legs of options. They have to roll and manage those positions and deal with assignments and expiries, and that's a lot of work. But they can just do that in an ETF format and pay a management fee for it. So that's very appealing to people who like that exposure. I would say a great example of that now, I mean, there's several, but like buffer ETFs are something that have gotten very popular, right? So a buffer ETF typically is just equity exposure that has what's called a put spread collar attached to it. So a put spread collar is where you sell a call option on the upside, and you use the proceeds, the premium that you get from selling that, to buy a put spread to sort of give you some hedging protection on the downside. And a put spread is like buying one put that's closer to the money, selling another put that's further out of the money. That gives you protection kind of between the strikes of those puts. So maybe you buy a 5% out of the money put, sell a 15% out of the money put. That's going to protect you from downside between 5 and 15, in a market crash on the way down. And a put spread collar is historically like the single most popular type of trade that a derivative salesperson will be out pitching to pension funds or equity portfolio managers or something. Hey, look, are you a little worried? Do you want to overlay kind of a hedge, a bearish position on your equities? And the ETF's pitch is, oh, well, we're sort of democratizing access to this, right? You don't have Wall Street sales coverage. You're not, trading with Goldman Sachs. You don't want to do this yourself. That's a lot of work. You can just do this and pay us a management fee. And so, that pitch makes sense in a way, although, as people who know me know, when you start talking about like democratizing things that retail doesn't have access to, I get really worried, because usually it means that they're sort of looking for suckers, right? They're just trying to expand their market. But so there's nothing inherently wrong at all with giving people nice, simple option structures that have some kind of logic behind them and executing them for them, and dealing with roles and maturities and stuff, right? That's all a big pain to do, and don't usually recommend that individual investors try to mess with that stuff. The question is all about the details, right? So one, what are the economics of this trade in of itself, and does it really make sense for somebody's objectives, right? So in the case of put spread collars, the thing about a put spread collar is, to first order, really what it does is just cut your equity exposure. It's not like a tail hedge, because you just own a put spread on the downside. It's not like if the world goes to hell, that's going to save you. It's just going to save you a little bit, right? Mostly what it does is just make your $1 of equities act kind of like 60 cents of equities. And if you want to do that, you can just only own 60 cents of equities. Like, that's pretty easy, right? And then you could actually buy 40 cents of bonds, and that's even better. And 60-40 actually probably is going to perform better than like equity plus put spread collar over time. So that's like one question, is like, does this strategy really make sense for your investment objectives? And then a separate question is, is this strategy sort of well designed and well executed by the ETF that you're buying? And the issues, and to your point about the risks that come up there, is these things are huge now, right? So there's like $95 billion of AUM in buffered ETFs that are all, largely speaking, very similar. And the thing about that is, these are all very big, they're very mechanical, they're fully transparent, right? So it's like, okay, here's this collar. The best example of this actually is, there's a JP Morgan mutual fund that does the same thing that a lot of these ETFs were sort of designed looking at. They're like, wow, this is a $20 billion mutual fund with high fees, let's do that. But in ETF format. And everybody in the market talks about this JP Morgan collar fund all the time. They know exactly when it's going to roll. They know exactly what strike ranges it's going to be in. Everybody's trying to front run the thing. And so the execution that they get is not very good execution, right? Because you get good execution by having nobody know that what you're doing, and nobody know that you're coming, right? And then the second thing is that size of trade, especially in stressed market conditions, when liquidity gets poor, you're just going to get really bad execution, right? Those kind of structures, when they're rolling from one maturity into another just before expiration, if you're a $22 billion fund with a put spread collar, it could have 100 delta on it, depending on where you are in the strikes, or it could have 0 delta, it could be out of the money. And then they're rolling into a new structure that has like a 50 or 60 delta, so 10 or 12 billion dollars of equity market exposure. So you're doing a live options trade in the market that has like $12 billion of directional equity exposure, right? So you're going to get your face ripped off on that execution, because no bank in the world is going to make a tight market on $12 billion of equity. That's crazy, especially in a stress market, right? And so this is kind of like a recipe for just absolutely disastrous returns relative to benchmark and mid-market during a stressed market environment where option market liquidity is deteriorating. Nobody wants to put this up. The historical case study of that is December 2018 with Harvest Volatility Management and UBS Yes that ran giant option iron condor programs that this exact kind of thing happened to. Like, they were trying to roll these enormous structures with tons of delta. The markets were massively wide. They just kept sort of crossing massive amounts of bid offer, and they lost 10 times their annualized volatility expectations in a month, and got sued, had class action lawsuits and all this kind of stuff, right? So this is what's going to come up.
Scale is the blockchain that's truly built different. Forget gas fees and waiting. Scale offers a seamless Web3 experience with fast, fee-free transactions. Whether it's gaming, AI, or next-gen dApps, Scale is here to power your future. Explore more at scale.space/ecosystem and follow them on X at Scale Network. Correct me if I'm wrong, but it sounds like the main, criticism, or at least something that should be more clarified here, is this tension between the idea that effectively retail is being sold this idea that you should have some sort of long volatility hedge or some sort of downside protection, whether that's just buying a classic, long put, I don't know, like a 20 delta out of the money put or something, to protect your existing, spot longs, or even go as far as, putting on like a collar risk reversal or something like that. And it's like, okay, well, even more so, we can give you this nice package that's in an ETF. And oh, look, we can get the fees off of, buying the put, selling the call, and also having the shares itself. And so it's like, okay, you don't need that 60/40 portfolio. All you need to do is, have this nice protection, but still be able to have the upside exposure. Um, so I want to ask you about, whether that's a valid thing that you can consider for the average retail investor, because, something I think back to is, when I think about like the two, big vol people that have educated myself personally a lot is like yourself, and then also Chris Cole, for those that, may or may not know him, but his view and a lot of like educational work he's done is this idea of, everything is either long vol or short vol. And this idea that, pretty much every average retail investor is effectively short vol in one form or another. And it's very difficult to actually get long vol, and more so getting long vol without having some sort of performance drag. So underlying this whole idea is there's this expectation of you can effectively get a free lunch where you can have your long-term passive longs or whatever. And oh, look, there's this nice little collar that we can put on there as well. And everything's all great. But the idea is that there is no such thing as a free lunch in finance, and you are paying up in one form or another. So is the main criticism there that they're being sold something that isn't quite necessary, or do you feel like it is necessary for some people?
No, I think that's right. So there's absolutely no free lunch in finance, right? It costs money to buy portfolio protection because people are willing to pay for portfolio protection because it's valuable, right? The reason that there's risk premium in the world, and it costs money to buy options over time is if it didn't, then, Benn would go buy all of it in the entire universe. And like when the market crashed, Benn would be a trillionaire. And like, so Benn's going to do that. And so therefore vol costs money, right? And the idea that you're going to be able to easily put something in your portfolio that's really smart because it's derivatives and somebody told you that it's smart, you should be really, really skeptical of that, right? Now, if you have less risk, there are specific reasons why you might want, certain adjustments to the risk reward profile of your asset allocation. I mean, it might be that you might say, look, I want some equity exposure, but I really can't lose more than 30% because I have I won't be able to like afford to retire. And so like I'm willing to give up some upside to sort of protect that downside, right? Or if you're a big pension fund and you have specific like large outflow obligations on certain dates, you might say, look, we're going to do a ladder of hedges here to make sure that no matter what happens, we can like make those payments that we need, right? So those are all like totally legitimate use cases. But the idea that just all the time I'm going to be able to put something in my asset allocation that cuts my risk without cutting my upside meaningfully, and I'm just going to have a better portfolio is a big stretch, right? And especially as a retail investor, ultimately what I tell people is figure out what your risk tolerance is over a long period of time and have a portfolio that it makes sense from that perspective. Have less risk in your portfolio if you can't afford to take risk. Have more bonds, have more cash, have more gold, like whatever your thing is. But don't be thinking you're going to find some easy long volatility exposure that's going to just balance that without giving up a lot of upside.
Yeah. So just to ask it super succinctly, do you believe there's any way to be able to, tail risk hedge or go long vol without any sort of performance drag? Because there's always, I've heard another big vol person is, Nassim Taleb, who's talked a lot about, and, runs like a tail hedge risk fund. And I know there's always like this, mysterious debate of like, can he basically go long vol without performance drag? And I may have this wrong, but I think, one of the ways that they start to do that is potentially like back spreads as a potential payoff diagram for options. But would love to just hear, like, do you think there's any way, or is that just, nonsense effectively? And again,
So a couple of things. For something that is truly I would differentiate between, tail hedges on the one hand and things that kind of statistically, historically have tended to make money when, markets go down. Those are two different things. So I described a little bit like our absolute return strategy and how the kind of return stream that we have. We tend to make money in bad market environments, but we are not a tail hedge. A tail hedge is something where you own a particular payoff, and if equities are down 30 or 40%, you sort of know within some reasonably tight range like how well it's going to perform and why, and it's because you own put options or whatever it is, right? That's sort of what a tail hedge is. A tail hedge is not some trend following strategy that like on average you think does well in bad markets, right? Because like it could just not do well in bad markets. It could lose money in bad markets because the trend doesn't deliver in quite the right way, right? And like if you tell your boss you have a tail hedge and then it loses money, you're going to be fired, right? So I would differentiate those things. So you can absolutely find things that make money in normal market environments and tend to make more money in bad market environments. Those are not easy to find, but you have to pay up for them. But like that kind of exists. If you're buying a true tail hedge, you will have to pay for that, and you will absolutely lose money over time on a standalone basis on that. Full stop. Nobody in the world thinks that's not true. The type of argument that Nassim would make, and that I would agree with, like up to some point, and then it's all a question of degree and empirical analysis, is if you have a long risk assets portfolio and you pair that in a really smart way with a very efficient tail risk hedge, and you're very actively rebalancing between the two. So when the market crashes, you're selling out of that tail risk hedge, you're using it to buy risk assets at super discounted prices and keep yourself and enable yourself to take a lot of risk in really bad market environments, and then catch the rally back. And you're doing this kind of very active, careful rebalancing between your tail program and your core risk assets. You could see a faster rate of compounding in that overall portfolio, along with less risk. That's possible. It's not a given by any means. It requires doing that really well, and it requires really finding relatively cheap hedges and all that kind of stuff. But like that is a thing, and like that's something that we talk about a lot. We have a little paper on that. But that's very hard to replicate. You're not going to sort of be able to, that's the thing about like trying to run tail risk hedges yourself as an individual investor, for example. So first, you need this concept of like being able to find really cheap tail hedges, and how do you know what those are and how do you size those things? Second, you have to be managing those positions really carefully. You have to be monetizing the right levels. You have to be rebalancing in the right way. And that's really hard. That's a ton of work, and is like a very high bar for, to expect an individual investor who has a job and, does other stuff to be able to pull off.
Got it. Okay. And just to further this education on this, I want to ask you about a few different derivatives and misconceptions that I'm hoping you can help clear up for people. And the first one I want to start with is just around this idea of the wheel. You have a shirt there from Option Sellers.
Yes.
Absolute legend. But that is a good reminder of what happens when a rogue wave hits, to say the least. But I want to start with that because it brings up this misconception of retail investors and traders that are getting into things where they might not know the undue risks associated with them. So I would love to start with this idea of the wheel. If you could just explain what it is, and then what are some of the undue risks that people are taking on as they go about employing the strategy?
Yeah, absolutely. That's a great question. Yeah, for people who don't know, this shirt is a picture of James Cordier, who ran optionsellers.com, and it did not go well. So the wheel, yeah. So this is a fun one. So the idea of the wheel is, as it would be described by its proponents, is what you do is you probably have a stock that you like. You want to be long this stock. What you're going to do is you're going to sell a put on this stock, probably somewhere below the spot price, 5 or 10% below, at a place where you'd like to own the stock. And you're going to get some kind of option premium for that. You're going to get paid for that. If once the stock eventually goes down and you get exercised on that put, you're going to get long the stock, and then you're going to own that stock. You're going to sell a call against it. So you're going to have a covered call position. And then you're going to wait until the stock rallies enough that you get assigned on the call, your stock gets called away, and then you're going to sell a new put. And so that's why the wheel, it's sort of this circular thing where the stock is going up and down. You're selling a put, you're selling a call, you're kind of going back and forth between these positions. And so it's a option selling strategy. It's a short volatility strategy. The way that usually the TikTok influencer types who are pushing this strategy would describe it, they don't talk about it in terms of volatility or in terms of risk reward on the options that you sell. They kind of try to make it sound like it's free money, like all of these different outcomes are good no matter what, right? So if you sell the put and the stock goes up, then you made some money on, you made some option premium, and that's good. If the stock goes down and you get assigned the stock, then you bought it cheap, down where you wanted to buy it, and you like that, that's good. If you sell the call and the stock doesn't move, then you're in the call premium, that's good. But if it rallies and you get assigned on the call, that's good, because the stock went up that you owned. And all of these outcomes are sort of good, and you just like make money over time and you're earning income. And they'll talk about the income in terms of the premiums that you're selling, right? So that you'll hear claims like, oh, you can make $200,000 a year with only $250,000 in your account, but because you're like selling all of this option premium that adds up to like $250,000. But obviously, like, that's not the income, that's not the P&L of the strategy. You lose, that's the premium you got. That's a 1.5 year payoff. The other half of your payoff is when the stock moves, and sometimes you lose a bunch of money, right? And so it's very misleading how these things are marketed and pitched. The risk that you're taking, obviously, is that you're short volatility in these positions. You're just short a put outright. If it's fully cash secured, which is sort of the safe way to do it, then it's not any more risky than owning the stock, right? I mean, the worst outcome is it goes down to zero, and you lose, as if you just owned the stock. But still, that's obviously quite risky. It's just like owning a stock. And
just want to clarify super quickly. When you say cash secured, are you mentioning in terms of like, okay, if it's like at 80 delta or something, you own 80 shares, or is it more so just that like the cash secured, like say if you're selling a call, it's like you have 100 shares for that call that you're selling?
Yeah, it's exactly that. So if you a covered call would be the size of the calls that you sell is exactly the same as the size of the shares that you own, so that you have the shares to deliver if the call gets assigned to you. And then on the put, it's the same, where if you sell 100 puts, you have enough money to buy the stock at the strike price if the stock gets down to the strike, so that you're, and the reason that that's kind of safe, right? You're not going to get a margin call and get blown out, because you always have the stock to deliver or the cash to deliver. So it's an unleveraged strategy. The risky thing, of course, is if you look at this and you say, oh, well, I'm making 3% a year, I feel like I should be making more, so I'm just going to sort of do 3 times the size, in this, and try to make 9 or 10% a year. And then, of course, if you get a big enough move, you can just get margin called and your whole account blown out, because you don't have the cash to deliver against the shares and so forth.
Scale is shaking up the blockchain game. With a gas-free, invisible experience, it's the perfect solution for developers and users alike. Forget unpredictable fees. Scale's innovative model ensures smooth, cost-free transactions, saving users over $9 billion so far. With over 46 million active wallets, Scale is proving itself as the go-to blockchain for gaming, AI, and more. Explore the Scale ecosystem at scale.space/ecosystem and follow the journey on X at Scale Network. And so is the main criticism here is just that, they're being promoted as basically just a, income based on just this simplistic view of delta, but there's really no consideration for, where's gamma at, where's implied volatility at, and that you basically have to take a view on this, because if you're selling a put, I don't know, right before earnings or something, obviously that implied vol is going to be higher than it would be at a different time. So it's, would you say that there is a way to actually do this? It's just you have to be aware of the risk that you're taking on and actually having a view on?
That's right. I mean, there's nothing inherently wrong with selling options if you understand what is the trade that you're doing, what's the payoff look like, is this a risk reward that you like, and how do you assess that, right? That can be fine. The issue is the misleading marketing, the risk that's not well understood, and exactly as you said, this is a volatility trade, right? So how do you lose a lot of money doing these trades? It's take this kind of wheel example, right? So you sell the put. The stock gaps down 10 or 20% and you lose a whole bunch of money on your put. Eventually you get assigned the stock and you sell a call against it, and then the market rallies way back up to where it was before. You don't make any money because you were short the call, right? So you just get your little bit of put premium, and then you're sort of back where you started, having lost money the first time on the gap lower, having not made any money again on the rally back, right? You're short volatility, you're exposed to this big market chop in excess of the premium that you're getting paid on the put and the call. And nobody selling the wheel strategy will ever explain that to you, right? That's sort of, they say, oh, if the stock is just like choppy in a range, you're going to do great. You're just going to be earning all these premiums while the guy who owns the stock is not going to be making money. Depends on the path, depends on the volatility, depends on a lot of things that they're not explaining to you, right? And that's really the big thing. And, it tends to be, when you look empirically at over time, because a lot of people sell options and there's not a lot of risk premium in short-term options, like if you look at equity index, you do much better on both absolute return and risk adjusted return just owning stocks than you do trying to sell options on them, do cash secured puts or covered calls. And so, retail investors should be very biased to just owning stocks. Like it's much easier. You don't have to think about all this stuff. You don't have to be, in your account sort of clicking buttons and possibly screwing up option exercises and stuff. And you're going to have better long-term returns. You're going to have better risk-adjusted returns. But again, none of these influencers will tell you that.
Yeah. What about some of the more simple uses of retail with options? So, obviously call volumes have just been absolutely skyrocketing for years now, and it doesn't seem like there's any signs of that slowing down. But there's a few different methods that are being utilized for that. There's either, the 0 day to expiry call volumes, which are exploding. There's just the simplistic, okay, instead of buying shares of this stock, I'm just going to buy a call because it's leverage and just view it as like a simple leverage vehicle. Or there's, just, what I view as perhaps a bit more sophisticated, which is, leap calls where, instead of just having, a bunch of shares, is that instead I'm just going to replace it, but still have it be like the notionally the same or like that. And just basically having it be more capital efficient. Are there any ones of those that you feel that are, decently warranted? And then on the other side of that, is there any undue risk in either of those three that people may not be aware of?
Yeah, absolutely. So when people ask me, what are sort of legitimate uses of options for individual investors who aren't sort of super, super sophisticated, these are some of the things that I'll bring up. So, look, if you are a good fundamental investor and you have a view on earnings and you have a catalyst event and you want some directional exposure to a stock, but buying a call spread or buying a put spread or something, as long as you're careful about execution and get reasonable prices, like that's kind of a fine thing, right? Because you buy a call spread, you know exactly what your maximum payoff is, you know exactly how much you're risking, you know what the ratio of those things are. I'm going to make 5-to-1 if I'm right or something, right? You get a little bit of positive asymmetry. That's like a very, very reasonable thing. That's something that equity long short hedge funds do and macro hedge funds do. And I have no problem with that. You need to make sure that you have some edge in what you're doing, because if you're sort of repeatedly buying options and you're just usually wrong, or you have sort of negative expected return of your trading, you're just gonna lose money the same way you would if you were doing stock. The other use case you described of just getting a little bit more cash efficiency is also, again, fine. I would generally don't endorse people taking lots of leverage, but if you're whatever, if you want 25 or 50% leverage on your equity positions, a little bit better cash efficiency, you could buy a call and sell a put. You could buy a leap, and those are reasonable enough things to do. Again, being careful about execution and not paying too much spread and everything. 0 DTE options you see very heavily used for intraday directional speculation. Again, I don't really recommend intraday sort of punting on delta. That's really hard. But if for some reason you have a strong intraday directional view and you just want to be long a stock until the close, and you just want to pay a small amount of premium for an option that could pay out a lot if you're right, again, totally reasonable use of this kind of thing. The key thing again is not overdoing it, being conservative, and making sure that you have some edge behind these decisions, because if you're just buying tons of options randomly on random directional views, you're probably going to lose a lot of money.
I feel like one of the big things we've hit on so far is that if you're playing around with options, is that there's a lot of different variables and you may not be aware of all the variables that are at play here. There's Greeks, and then there's the third order derivatives of Greeks as well, and all of that. There's so much more than what it looks like on the surface. So I want to ask you, do you think that the average person would be better off just in something like, if they're trying to, if they're decided that they want to use derivatives, would they be better off if they, just buying call options, or would they be better off in the futures world or forwards and that sort of thing, where the main risk on that side is obviously the margin risk associated with it, versus long options where your main risk is just losing the premium?
Yeah, I think it depends on what they're trying to do. So futures are great for cash efficiency and for taking directional views, and they're much simpler, right? So you don't have to understand volatility pricing and all these things. If you're buying really short-term options, or if you're buying short, call spreads, you don't have to think too much about volatility. If you're buying 0 DTs, you don't have to think about volatility. You just think about price, right? I'm paying $2. I think the thing's going to go up. If it goes up 10 points, I'm going to make $8. Sort of, you don't need complicated third order Greeks to kind of think about that problem, and it's fine. Same thing with buying a call spread ahead of earnings. you get into trouble when you're trading, meme stock options at 900 implied vol, because the behavior of how the price of that option will move is very complicated, because vol could move a ton, and so the stock could go up, but you still lose money because vol went from 900 to 600 and all this kind of stuff, right? So in the edge cases, it gets pretty weird. But I think that there's a lot to be, keeping it simple is really, really good, right? And again, futures, keep it simple. Short-term call spreads and put spreads, keep it simple and aren't too levered to implied volatility, because you're long one option, you're short another option, and the net package doesn't have as much volatility exposure as just an outright call. So yeah, I think that's generally right.
Yeah, there's always great lessons to be had in the markets for people as they explore it, whether it's, buying a long call right before earnings, and it's like, oh, look, I was right on the delta, but I still lost money somehow. Or again, like buying puts on GameStop when it exploded higher, and it's like, oh, look, the price went down, but somehow I still lost money.
Yeah.
There's a lot of great ways to learn.
No, that's exactly right. Like, somebody was in my DMs not too long ago who had bought some call options on an AI stock ahead of earnings, and it moved a decent amount on earnings, but the value of the call option dropped a lot. And so we got into a conversation about like how you can measure the implied move in a stock from the term structure of options, and how much does the market think the stock is going to move on earnings. And if the answer is 30%, it might move 20% on earnings, and that seems like a big move, but you're going to lose money because the market was pricing 30.
Yeah, I'm glad you brought that up, because oftentimes people will look at what are the options implied probabilities of some sort of event occurring. Can that be misconceiving? And why is it?
Yeah, it can be. So like, one thing, for example, that you'll see relatively quantitative people are interested in is the implied distribution of stock prices, for example, right? And you can get the screen on Bloomberg. It sort of shows you the shape of this curve, and it's definitely interesting and informative, but there are pitfalls here. So, for example, you'll see, because of skew in equity derivatives markets, the implied probability of the stock market falling 20% in a month is going to be much greater than the implied probability of the stock market rising 20% in a month. And if you go and look at the historical data on 1 month equity returns, you'll see that there's some skew in the distribution, but like sometimes stocks go down 20% in a month and sometimes stocks go up 20% in a month, and it's not sort of wildly asymmetric. And so you'll sometimes get a slightly naive quant trader saying, oh, like that's a inefficiency, that's a mispricing, that means that I'm supposed to sell 20% of the money puts and buy 20% of the money calls, because like this implied distribution is way out of whack with the true sort of realized distribution, right? And the thing they're not thinking about is the implied distribution reflects risk premium in the marketplace, not just expectations of what's actually going to happen in real term probabilities, right? And what that means is there's a clear distinction in quantitative derivatives pricing between sort of the real world distribution and what's called the risk neutral distribution, or the options pricing distribution. And again, that reflects risk premium. So what's going on here? Money is objectively more valuable in a state of the world where stocks are down 20% in a month than it is in the state of the world where stocks are up 20% in a month, starting from a quiet time. Because if stocks are down 20% next month, it means probably things are really scary. Something weird just happened. There's probably all kinds of really good value buying opportunities, probably dislocations. There's all kinds of stuff you could do with your money that's really interesting and exciting, much more so than there is just with you and me sitting here today. And that's really worth something. You saw that obviously in 2008 and in 2020, where if you had cash sitting on the sidelines at the worst points in the market, there's all sorts of awesome trades that you could do and make lots and lots of money and be in a really great position. And the market's willing to pay for that, right? Because that's a really valuable thing. And so it costs you a lot to protect you to buy trades that are going to work really well in those big down markets, right? And if you sort of blindly go out and look at the implied distribution and say, well, I'm going to sell a bunch of puts, what's going to happen is 2008 is going to happen, and you're going to be fired and you're not going to be able to do any buying of stuff. And what was your lessons from sort of the implied distribution, right? That's, I think, a really important thing for people to get through their heads.
On that note, this is a bit off the cuff, but underlying a lot of financial formulas and finance in general is this idea of normal distribution, which is getting at what you're talking about here in terms of like, Black-Scholes like options pricing is there's these underlying assumptions of a normal distribution. There's a lot of debate about whether, financial markets are normally distributed or not. Do you think about that much in terms of, obviously you're an operator and you're in the weeds every day, using options and derivatives that are priced off like normal distribution assumptions, but how do you think about that?
Yeah, totally. So this is actually a great question. I have a tweet thread on this I'll send you. So this is I think a really important, probably the biggest misconception in simple people who start thinking about options. Nobody on earth believes that markets are normally distributed in any way, right? Option markets certainly don't price as if things are normally distributed, right? All that Black-Scholes is sort of an accounting convention that lets you translate the price of an option with a particular underlying, a particular maturity, and a particular time to particular strike into a volatility number that has some kind of a sensible meaning that can be compared to other options, right? So I can talk about what's the vol on a 3-month, 20% of the money option versus 1 month, at the money option, right? Normally distributed markets would mean the volatility surface is flat, right? That's sort of what the implication of normally distributed markets is. Obviously, volatility surfaces are extremely not flat, right? Everybody sort of knows the world is not normally distributed. The market prices exactly the way in which they are normally distributed. How fat are the tails? How fat is the left tail versus the right tail? Over what time horizons? What event risk is priced in? Like all this kind of stuff, right? And so there's no sense in which using Black-Scholes to talk about implied volatility is sort of assuming that markets are normal. It's literally just an accounting convention that translates price, this multidimensional problem of sort of tenor and strike and what underlying is it, into this kind of variable that can be compared in an intelligent way. And then you can analyze the dynamics of the volatility surface and what's driving it and how you actually hedge options and all this kind of stuff. But yeah, that's exactly the way to think about it. Is nothing normally distributed. Nobody thinks it is. Markets price very specific ways in which markets are not normally distributed.
Yeah, so it's mostly just like useful ways to comparatively compare different, derivative products and say, this one is relatively good versus that one. And it's just we've iterated, like we've gone from, like a binomial options pricing model to Black-Scholes one now. And, they're not perfect, but they're just ways to relatively compare, basically.
Just a data normalization or an accounting formula. Yeah.
Yeah, cool. Okay, so I want to talk a bit about how all these different dynamics that we talked about and how they're starting to impact the market as a whole. So, earlier in the show, you mentioned the JP Morgan collar trade and how the role of that, people focus on that very closely. There's a, increase. It's basically a one-way up graph in terms of just the amount of notional exposure of just derivatives in the market in general. And I want to ask you about how do you think about how these different, increases in uptake of these different derivative products affect the broad market? Obviously, it feels like every couple of years we have these vol events. There's the 2018 Volmageddon, and then just recently in August we had another event. I don't know if we've come up with a name with it yet, whether it's like, I don't know, just the vol dispersion event or something like that. But how do you think about how these events keep recurring and how there's different event catalysts towards it, and just the broad effect of derivatives on broad markets in general?
Yeah, absolutely. So certainly you've seen continued growth in derivatives markets and at different paces in different markets. Big retail participation, big institutional participation. A couple different things. So one, when there is a really, really large outsized flow in some part of the derivatives market where tons and tons of people are doing the same thing in the same way, kind of all buying or selling the same thing, that creates interesting dislocations that can affect how the underlying markets behave. So an example from the last 10 or 15 years is starting after about 2012 or so, the whole world steadily became sellers of short-term options for income type of strategies. So starting with call overwriting, a lot of big pension funds in 2012, 2013, 2014, cash secured put selling becoming a really big thing starting 2014, 15, 16, retail starting to pile into these strategies with option influencers and all this stuff. So these days, the overwhelming flow in, call it 1 month benchmark oriented between 25 delta call and 25 delta put wing is all option selling. And so then there's very few natural buyers of that flow. The people who buy it end up being people like us and obviously dealers and market makers who are buying it because it's so heavily oversold and so cheap, not because we have some natural use for it other than that. And what that tends to mean, because those are very short dated options that are being sold, they have a lot of gamma. So those people who own those options and have to hedge them, we are always effectively trading against the market, right? So if you own an option, let's say you own a call option and you're short some stock against it in order to hedge it delta neutral, if the market goes up, that call option is going to get longer delta, because it's a positively convex thing. That's true of all options. And so if I'm hedging it, that means I have to sell some stock at the end of the day or throughout the day, right, when that stock went up. And when you have very outsized flows like this and the whole world is selling gamma, and then professionals are buying it who delta hedge it, right? The people who are selling it are not delta hedging on a daily basis because they're just doing call overwriting or cash secured put selling or something, right? That creates this kind of mean reversion dynamic in markets on a day-to-day basis, as long as the market is reasonably close to like the strikes of all these short-term options that have been sold, because the market goes up 1% and like Goldman Sachs and Morgan Stanley and QVR are all selling stock to rehedge. Market goes down 1%, we're all buying stock to rehedge. And that's a pretty well-known dynamic in general. It's given rise to this whole cottage industry and like people trying to measure gamma positioning and all of this. And some of that is better than others. A lot of it's not very good, but the underlying phenomenon is absolutely real. And in general, what that creates is a lot of short-term mean reversion in price action, with markets kind of trading in a range, but that can go away if markets have sort of drifted out of that range, so that we're moving further and further away from the strikes of all those options that were sold last month, around expiration. Because when you think about a short-term option and the gamma profile, how much gamma convexity does that option have? It has a lot right near the strike, but as the market moves away from the strike, it loses convexity really, really fast because it's a very short-term option. And so that's why a lot of the big sell-offs that you've seen, historically in the last 10 or 15 years, they start out with like a choppy downtrend for like several weeks on relatively low volatility, 1% moves and stuff, like grinding down through that convexity. And then once they're down, 5% or 6% or 7%, then, over a couple of weeks, then they're much freer to actually sell off really hard, if there's something actually going on that catalyzes a sell-off. Whereas it's very hard to like just out of the blue have a 5% down day in the S&P because there's so much buying pressure from convexity on the other side of that. So that's a good example of a way that a big trend in derivatives markets has affected, the price action in the underlying.
I won't press you too much on what are ways to take advantage of that, but maybe we could just dig into, what are some of the ways that aren't very useful of trying to, at least take advantage of these events, because, the first thing I think about is the VIX, and during these big vol events, we just see VIX explode higher, and the initial thinking is, oh well, I'll just buy I'll buy a bunch of out of the money VIX calls or something like that, and I'll just sit on them and then wait for these events to happen, and I'll just sell them at the top. And life's not that easy when you get into the weeds of it. So I want to ask you about is there any useful way for just the average person to do it? And then on the same vein, why is that a bad idea to just sit on VIX calls and hope for that to happen again?
Yeah, absolutely. So, again, markets are reasonably smart, right? I mean, VIX calls aren't cheap. You can go buy VIX calls, and most of the time you'll lose money. And eventually there will be some vol spike and you'll make a little bit of money, but odds are you won't make back as much money as you've lost so far, buying those calls, and unless you have a strong sense of timing, right? It's generally speaking, anything that's like a defensive or hedging, trade, or betting that the world is going to blow up. If you just kind of do it all the time, you're going to lose money over time, and you should, and that's exactly what you should expect. There's no like market manipulation or sort of like deep state involved in that, right? That's just risk premium. That's literally how it works. Now, if you have some kind of informed sense of timing, that's a little different. You brought up XIV. XIV was a very specific dynamic in the marketplace, this kind of this inverse VIX ETF that became so big and so popular and so crowded in a very, very low volatility environment, right? And for that, like every volatility and derivatives trader in the marketplace knew about that and was talking about that and was saying, guys, this is going to blow up. Like, this is really, really easy for it to blow up. It guaranteed will blow up. We don't know when, but with vol really low, it's very easy for vol to go from 10 to 17 and guarantee the blow up of this product, right? That's much easier than getting vol to go from 40 to 70 or 80 or something. all it takes is 1%, 2%, or 3% down day in the market. And this was kind of the conversation that everybody was having. And, timing was harder, but you knew with vol at 10, again, all it would take was it wasn't costing that much to carry VIX calls. And all it would take was a very small event to blow up XIV. And that's kind of exactly what happened. So like in some circumstances, when you do have a sense of timing and catalyst and what could actually drive it, then those kind of trades like buying VIX calls could make a lot of sense. The difference is between that and just generally saying, well, like I think the world is going to blow up someday. I don't really have a specific sense about that. And I'm just going to constantly be buying VIX calls or buying S&P puts or something. That, again, is going to tend to lose money over time.
Could you expand a little bit on why is it that, VIX going from 40 to 80 is not as much of a big event as it is from, like VIX going from 9 to 12 or something like that? And to that end, if you could also just tie in something they're very well known for, is why is it so bad to quote that VIX number? Like, why is it so bad to say that in terms of, oh my God, the VIX is up 40% that day, but rather you should be talking about it in terms of basis points?
Yeah, totally. And that's like it's a little bit of a meme. Like, when I kind of come out saying that, everybody knows that it's sort of like an inside joke, right? And that's, that we laugh about. There's nothing inherently wrong with quoting volatility moves in percent. It really depends on what you're trying to say or what you're trying to get at. The thing that I caution people about quite a bit is percentage changes in volatility. The distribution of those changes is very dependent on the initial level of volatility. So it's much, much easier for volatility to double in the S&P from 8 to 16 than it is for it to double from 40 to 80, right? Because volatility is the square of vol. If things are really, really quiet, vol might be 8, and then there might be some negative headline and the S&P might go down 2% and vol will be at 16, and that's just like no big deal. Like that could happen anytime, like, and not surprise anybody. But go from 40 to 80 VIX, I mean, if you have if vol is 40 and we have a 2% sell-off, VIX probably won't go up at all. It actually might go down. It might go down to 37 or something because we're already at 40, right? To get from 40 to 80 in one day, you probably need a 15% sell-off or an 18% sell-off or something like extremely dramatic where people are screaming in the streets and stuff, right? So that's what I mean by the distribution of percentage changes in implied volatility is not sort of this unconditional invariant thing. It depends a lot on the starting point of vol, right? And that's the mistake that people made with XIV. The issuers of XIV were going around saying, look, this thing could survive like a Black Monday crash. Like we could survive 20+% equity market drawdown, which Black Monday happened with vol starting in the 30s. I think it's still nonsense to think that vol wouldn't have doubled to 60 from 30, but like at least that would require a pretty big move. If you had Black Monday crash starting from, you wouldn't need a Black Monday crash starting from vol of 10 to double vol, right? Again, we showed that in February of 2018. It took a 4% down day, and it totally obliterated the entire XIV space.
I want to shift gears here and chat about some macro. So for those that don't know, not only are you a vol hedge fund manager, but you also have a PhD in economics, and that was a lot of your work beforehand. And I want to lean on that a little bit. So I want to talk a bit about, first off, just getting an understanding of, as we move and navigate into this new Trump administration, and there's dynamics of tariffs and just this secularly increase in event risk. How does that translate into, vol managers and just hedge fund managers as a whole? Like if you're just, you could just be going through your day and then a random headline can come in and that could just completely send markets in an opposite direction. Like what does that do to VAR models? What does that do to risk management in terms of just trying to navigate that?
Yeah, totally. It's a lot of fun. I mean, think about, think whatever you do of Trump, I think everybody knows what I think of Trump, but he's definitely not a low volatility president, certainly this time around, right? And I think his supporters would agree with that. He's determined to shake things up, like so is Elon, right? They're trying to make dramatic sort of shock and awe changes, front loaded, like get a ton of stuff done in a big way. There's a ton of headline risk. The environment is totally saturated with crazy new headlines that sometimes reverse themselves 2 hours later or the next day. You're not totally sure what's going to happen. So you get a 2% overnight sell-off that rallies back to flat or up by the next morning. And it makes for a really interesting volatility trading environment. You have to think a lot if you manage a derivatives portfolio about how you hedge your deltas, because you might all of a sudden find yourself really, really short after the market sold off really hard, but you might be worried that he's going to contradict himself an hour later, and you better hedge now. There's all those sorts of questions come up, for volatility managers. So it's certainly for a portfolio that tends to be long gamma, because gamma is so cheap because the whole world's selling short-dated options. That's generally a good problem to have. And a lot of the questions that come up become with what frequency are you actually hedging out that exposure? You don't want to hold it too long because the headlines might reverse. A lot of what's going on in the market now is sort of figuring out how much weight to assign a new Trump headline, right? Because he comes out and says something that sounds crazy. Okay, is this just bluffing? Is he really going to do it? Even if he starts to do it, is he going to stop doing it, the next day? And the market has started to discount, I think, more and more, because we saw with a lot of the tariffs headlines, like with Mexico and China, right? Really crazy headlines. We're doing this. We're putting the 25% tariff. 2 hours later, okay, we've made a deal. Like, they're going to send some troops to the border, and we're not going to do that. We're going to delay it by a month. So I think it'll be really interesting once you actually get, a big, meaningful, kind of scary policy that actually gets implemented and stays implemented. So if we do 25% across the board tariffs on a lot of countries and they actually stick, like, I think the market's then going to have to digest that, and that's going to affect how the market reacts to future headlines, right? Because, okay, wow, he really will do some of this stuff that the business community thinks of as very negative and very non-pro-growth, versus it's just a bargaining tool. He's not serious.
So speaking of tariffs, back in the fall, I had Stephen Miran on, who presented a paper that basically discussed the merits of tariffs and presented a number of arguments within that paper. Stephen Miran went on to be nominated at the Council of Economic Advisors for Trump. And so within this paper, there is a few different arguments made around just basically the necessary merits of tariffs and different approaches to currency devaluation. You came forth on Twitter and wrote a lengthy thread that served as a bit of a rebuttal towards some of the arguments made within that paper. So I wanted to open it up the floor to you to just present that rebuttal and just describe some of the criticisms and concerns that you might have with that associated with it.
Yeah, absolutely. That was a really interesting one. That was probably like one of the longest and most detailed threads that I had written in a little while, because there was just so much there to get after. In general, I think Moran, I think he sort of wanted the job that he has now, and that was behind a lot of this thread. But let's get into some of the details, right? So he starts out with the premise, right, that the U.S. dollar is overvalued as the global reserve currency because of capital inflows, and therefore, tariffs are potentially a way to deal with that, right? He's saying, oh, we have this sort of structural trade deficit. It's unfair to us. It's because of this reserve currency. And this is the kind of thing that people will make that kind of argument. And, okay, that's an okay starting point. Although, to be honest, very few, it's a little bit funny when people complain about owning the global reserve currency. I think most other countries would love to be the owner of the global reserve currency. But then he goes on to claim that tariffs cause US dollar exchange rate appreciation vis-a-vis trading counterparties that more or less fully offset the inflationary effect of tariffs. So before we get into kind of that specific claim, he started out with the premise that the dollar is too overvalued and that he wants to use tariffs as a tool to restore equilibrium and fix that problem. But then he's immediately claiming that tariffs actually significantly further increase the strength of the dollar, right? And so it's confusing as a starting point, sort of, what are his objectives versus how's he claiming that the world works, right? That doesn't make any sense. Then he has no explanation for why this would be the case. So why should the dollar appreciate when you raise tariffs on other countries? He never mentions anywhere in kind of the whole paper or podcast that the first thing that happens when you raise tariffs on a trading partner is they raise tariffs back on you, right? And you both just pay higher prices for each other's goods, trade with each other less. There's no reason why that should affect the exchange rate, right? But fine. So based on this claim, so I'm looking in the paper for, what is this, careful empirical analysis that he puts into place to figure out how dollar China was increased by 15% as he claims, to kind of offset the tariffs impact on the price of consumer goods in the United States, right? The broader literature totally disagrees with this. I did a question on this actually at the Odd Lots pub quiz the other day that was really fun.
Saw that.
What was his methodology, right? So it turns out his empirical analysis was and I think there's a slide on this if you want to show it, but he looked at the dollar China price chart from over this 2018 to 2019 period, and he kind of picked the low, which is around April of 2018, and he picked the high on the chart, which I think was might have been August or September of 2019, and he just like drew a line between those, and he said, well, that's about 15%, and he said that's the impact of U.S. Tariffs on the currency, right? By sort of picking a low and a high on a chart over a couple of years. So no, and I mean, this is not a traditional economic analysis, statistical analysis method of causal logic. Obviously, currencies move a lot over time for many different reasons, including dollar China. If you look at a long chart of dollar China, it's very volatile. It goes up 10 or 15%. It goes down 10 or 15%. You can see on this chart, shortly after it then went right back down 15%, even though the tariffs were still in place. Biden largely left, all those tariffs in place. So I mean, this had nothing to do with tariffs. The U.S. The Fed was raising rates, like all kinds of other stuff was going on. I think you have another chart here on other currency returns. So like lots of different currencies moved a lot against the US dollar. The US dollar appreciated against a lot of currencies, many of them much more than 15% in emerging markets. If you want to sort of argue that tariffs have a causal impact on exchange rates where, where the effect on the exchange rate offsets the price impact of the tariff, like that's a big empirical analysis that you need to do to sort of show me that that's true. And like, here's a low and a high on a chart, that sort of changed 15% over some period is not that, right? So this was kind of extremely underwhelming. And then if you go back to the literature, there's a big microeconomic literature that's very serious in trade on the inflationary impacts of Trump's 2018, 2019 tariffs. They generally find full pass-through of tariffs to consumers. So, if there was a 15% or 25% tariff, like the consumer just ended up paying 15 or 25% more. Again, lots of papers on this, very, very thorough. He kind of acknowledges that and then waves his hands and tries to claim that this is all spurious because of rerouting of exports through other countries with like some minimal value add. So obviously, like countries can, a business can reroute exports. A Chinese company could reroute exports through Vietnam and do some extra value add. First of all, that like takes a little while to set up. That's not the kind of thing that happens in 6 months or a year as soon as tariffs go up, right? Because you need to like go get a supplier and you need to come up with some actual value add on the product so that it gets counted as exports from Vietnam. But also for that to explain the empirical results, like not only does that have to happen very quickly and massively, it also has to specifically only happen in goods that are hard to pass through price increases to consumers, but not happen in goods where you can't pass through price increases to consumers. It's like this very, very implausible kind of hand-wavy argument about why this whole like literature in trade economics is nonsense. When obviously this is a very serious literature with like very serious research people. So it was very much kind of a BS type of answer. But he gets to say, basically, we raised tariffs on other countries, we raised U.S. revenue, and we made them pay for it, right? And this is like a very kind of Trump-esque line. Like this is sort of exactly why it's kind of like we built the wall and made Mexico pay for it, right? And sort of that's why he's saying this, right? This is sort of a job interview pitch for bumper sticker kind of politics. And he does it in a really funny way. I mean, he like at some point in the podcast, I think he said like, is it possible that currency doesn't offset the tariffs this time? Yeah, an asteroid could hit the Earth anytime. Like these are sort of like equivalent claims, right? When sort of his empirical analysis was like drawing line on a chart with a crayon. So again, just extremely underwhelming, dude.
So the main argument at hand here is that, based on traditional empirical literature, academic literature, is that tariffs are indeed inflationary. There's no way around that, and there's no two ways around it. And obviously, currencies can sometimes offset, but it wasn't proven into the degree that was required to be able to say to that certainty.
Yeah, there's no evidence that exchange rates move a lot in response to tariffs, especially if they're reciprocated tariffs. And certainly, there's no reason to think that dollar China moved a lot because of tariffs. It moved over some period of time. It moved right back. Lots of other currencies moved a lot in the same way at the same time that we weren't tariffing. There's no sort of empirical evidence presented of any kind here.
So, is there ever any sort of net benefit for tariffs ever?
So I think that it's a really nuanced question. You can look at historical development of very specific industrial clusters in emerging markets, where a country looked at like the aerospace industry or something as like strategically important and really wanting to develop specific capabilities and clusters of economic activity in that, and they used some combination of like export subsidies, tariffs, tax incentives to promote like something very, very specific, and that kind of working. And you can make that kind of argument, but there's absolutely no evidence ever that like really big, really broad-based tariffs across everything and trying to be like totally autarkic as a country has ever helped anybody develop and become wealthier and and create sort of benefits for for people, either from a distributional perspective or like an economic efficiency perspective.
Mm-hmm. Cool. Well, fair enough. Ben, it's great to get you on the show. I think we covered a lot of ground there. Really appreciate you coming on, and yeah, love to have you on again sometime soon.
Awesome. It was a lot of fun. Thanks for having me.
Yeah.